So you work in the asset management, how the fintech industry is changing your work?
Yeah, absolutely. So one of the core issues in the UK is the savings industry, how important and how large it is. I mean, so that last year the FCA, the Financial Conduct Authority, did a review of asset management, and they concluded that amongst other things there are 7 trillion approximately pounds of assets under management in the UK. And these are serviced by what is a very complex and very opaque value chain. So it's highly segmented. There are lots of intermediaries. And one of the propositions that I discuss with people is that if you can put technology in place to cut out a lot of those intermediaries, to make them straight through and end to end, the size of the market could be very big. So part of the job I'm doing at the moment is trying to figure out what the cost to the consumer is of using all those intermediaries, because that's the size of the business case. So I'm going through a process of segmenting all the different pieces and figuring out how big they are. My best guess, and it has to be a guess because no one's ever tried to calculate it before, is that to service that volume of assets probably costs between 2 to 3% of assets under management, which is 200 to 300 billion pounds a year. So if you're a fintech and you're looking to solve problems, your market size in that respect is 2 to 300 billion pounds. Now that's big. And the same problems are replicated around Europe as well.
Yeah, of course, but I guess, and we saw it also here during the Impact Conference, that there are already startups that are working with the asset management.
Yeah, there are, but then again, so how can I put this? In the UK, there are asset management startups, but largely what they're doing is they're working at the level of providing fund management services to consumers. So what they're looking is right at the very end of the value chain. So they're helping consumers define their risk appetite, to define their default funds, to define their strategies. But what I'm talking about is the operational stuff behind that. So there are fund managers, and then there's all the operational contingent costs, so brokers, custodians, technology firms, intermediaries, data providers. And that is the kind of stuff that's ripe for the sort of technology that people are looking at in other areas, things like distributed ledger and blockchain, things like machine learning, helping people understand their data better. Not machine learning in the robo-advisory space, but machine learning in the space behind that, which can take large amounts of data and make sense of it quickly, cutting out a lot of what might be considered manual processing and manual thinking. It's to help give scale. The size of that problem is the one I'm talking about, 2 to 300 billion pounds a year. Now, I'm not suggesting fintechs try and replicate it and charge 2 to 300 billion pounds a year, because then the problem is the same. But if you can cut that market down and take a large portion of that piece, that cost away, you're still left with a very compelling business case, maybe billions of pounds in size, but you do something else which is even more important, because you cut out that cost to the consumer. And anything that isn't a cost is a return, right? So it's a T account. On one side you have costs, the other side you have returns. If you take out 200 billion pounds, you give back 200 billion pounds of performance. And the impact of returning that to the consumer will be to double the size of their pension fund or more over the lifetime of a saving. So in other words, when you retire, instead of a pension fund of X or a savings of X, you have 2X. Now, I don't know anyone that wouldn't want to have twice as much money when they retire. So there's a very compelling business case there from a social point of view as well as a commercial point of view.
So is the fintech the answer?
Potentially, yes, it is. I mean, when I look at the marketplace, I see that this high cost is composed of two things. One is very inefficient infrastructure, very opaque charging, very opaque costing, and that leads to another problem, which is opaque pricing. So there was a market failure. And in the UK, the Financial Conduct Authority's report showed that there was a market failure in terms of competitive pricing. So they looked at portions of the marketplace and said there was no price competition. That's their way of expressing it, which basically means we have a form of monopolistic market. So gathering data on the marketplace will help correct that portion. But once that's corrected, we're still left with this inefficient infrastructure. So I wrote a paper a few years ago. One of the things I do is I'm a visiting professor at a couple of universities in the UK, so I indulge in research. I kind of enjoy it. And I looked at this, just a very simple equity retail fund, an equity ISA in the UK, and looked at what I saw as 16 levels of intermediation, 16 layers of cost that your money went through when you gave it to a financial advisor and it's put in the market. And anything that takes that 16 layers of cost and cuts it down to one is going to be good. And in fact, there is an organisation in the UK called Calastone, and they are a familiar market technology for settling and clearing fund units. And they have just taken their platform and implemented a distributed ledger framework for it. And they cover 2 or 3 layers of this 16 layers of cost. And they only do it for a portion of the market, which is retail fund savings. So not all of the 7.7 trillion and not all of the value chain. And their estimate is they will be saving asset managers or saving the consumer £1 billion a year, approximately, just by implementing a very small portion or contracting a very small portion of the value chain. So think about how far we could go with this if we got people to look at other layers within the value chain too.
During Impact Conference, you're also representing United Kingdom and inviting fintechs also from Poland.
Absolutely, yes. So I've been really impressed, when I'm here, at how big this conference is. So I had heard of it. I'd heard of Impact because this is the second year now.
Yeah,
I didn't come to the first one, but I really wasn't expecting it to be so busy. To have so many companies here, to hear so much about what was going on in Poland. So there's obviously a lot of companies here that want to do interesting things. The question I think you need to ask yourself as a startup here is, you have a market size of this big here in Poland and probably this big in Central and Eastern Europe. But if you start looking at the UK, the market is this big. So 7.7 trillion of assets under management, over £1 trillion in mortgages and long-term savings, £1 trillion in bank accounts and more. And then capital markets being based there. The market size is huge. The regulator is pretty friendly. It puts structures in place to support startups. So there is an environment in the UK that's supportive of people who've got interesting things to do in this commercial environment in the UK. So the point I'm trying to make is that actually don't be frightened to come to the UK with your company, with your idea, because we're still open for business, right? We still have these problems to solve. Those are not going to go away. We're still going to have 7 to 8 trillion pounds of assets under management, or several trillion pounds worth of payments as a marketplace.
Even after the Brexit?
Even after Brexit, it's not going to go away. The population in the UK is large. We have a huge financial hub in London. We've got other financial hubs around the UK, like Leeds, which is the retail banking hub for the UK. It's a very, very rich environment, and there is a lot to see and do there. But there's a lot of resource as well, and there's a lot of support. So all of these things are not going to go away. It's not difficult to find the opportunity. The only thing I would say, and the caveat I would have here, is that everybody always looks at London. Everyone always starts the conversation as the UK is London and financial services is London. And London's great. I mean, it's got everything that you need, but if you're a startup, it can be very expensive. If you're a startup, it can be hard to find resource there. If you're a startup, you can find it a very competitive environment. And what's more, as a startup or as a small business, selling to a big bank, selling to a big organisation can be really hard because you've got lots and lots of people to go through. The UK is a very diverse space, and there are tier 2 and tier 3 banks and financial services firms out there who have a very flat structure that it's much easier to sell to. So for example, you can go direct to the CTO and direct to the person who is going to buy from you as a small startup. And all of that corporate governance stuff that you have to go through, and compliance, multiple layers and checks and balances, doesn't exist in such detail for these organisations. And what's more, they exist in places where it is cheap, where there is resource, where there is scientific capability if you need someone to help you with, say, AI, big data. So Leeds, where I do a lot of work, has the UK's leading data analytics centre and an artificial intelligence research centre, as well as how many thousands, tens of thousands of graduates a year in data science coming out of it. So you can find these things elsewhere. So what I suggest to people is, yes, you'd like to meet HSBC. Everyone wants to. You'd like to meet RBS and Lloyds and Barclays. But think about Yorkshire Bank. Think about Leeds Building Society. Think about the fact that you've got 36 of these organisations in one place, in one city in the north of England, because that's a pretty good place to go.
Thank you very much.
You're welcome.
It was a pleasure.
No, perfect. Thank you.